Welcome back to the Daily Crypto Deep Dive. Today, we're exploring a question that's been echoing across the entire market over the last 48 hours. Is this the beginning of Bitcoin's next liquidity crisis? Not a price crash, not a panic event, but one of those powerful and slow-moving supply squeezes that end up reshaping entire market cycles. Because what we've seen over the past 24 hours, more than $1 billion worth of liquidations, huge outflows from leveraged positions, long traders wiped out across the board, and Bitcoin taking a heavy drop under $97,000. These events are dramatic, but they might only be the surface. Underneath, there's a very different and far more interesting story building around how much Bitcoin is actually left to buy, how quickly ETF demand can return, and how structural supply shortages form long before the market realizes what's happening. Today's episode is going to get into all of that. We'll talk about the liquidations, the difference between forced selling and voluntary selling, the role ETFs have played in tightening supply, the on-chain metrics that analysts swear by when they're trying to spot accumulation zones, and why several major research desks, from CryptoQuant to RK to Standard Chartered, are quietly hinting that this correction is the kind of moment that leads into multi-month squeezes. We'll also talk about the flip side, the risks, the macro pressure, and why some analysts still believe we need one more major washout before the next leg up. Now first, let's set the tone with what actually caused this drop, because the headlines can make it sound like something catastrophic happened. In reality, it was almost entirely mechanical. Bitcoin slipped, stop losses triggered, futures got liquidated, and that chain reaction wiped more than $1 billion from open positions. Around 60% of that came from longs. That's the important detail. When liquidations come from longs, it tells you the market was leaning way too aggressively in one direction. Traders expected a bounce. They got a cliff instead. And because these positions are often heavily leveraged, they get forced sold without the traders having any say in it. This is not smart money selling. This is not institutions dumping. This is mechanical pressure. A machine unwinding positions faster than humans can react. And as strange as it sounds, that's exactly what creates early liquidity crunch conditions. Because while these forced sellers are getting liquidated, the long-term holders, the ones who actually influence multi-year cycles, are not selling at all. In fact, they're doing the opposite. According to Glassnode's latest on-chain data, the amount of Bitcoin held by long-term holders is hovering near all-time highs again, and exchange balances continue to fall. Analysts love to argue about what metrics matter and which ones don't. But exchange balance trends are one of the few signals that almost everyone agrees on. If Bitcoin is leaving exchanges, it is almost always a sign of accumulation. And this is where the liquidity question starts to get interesting. Earlier in the cycle, ETF demand, specifically from BlackRock's IBIT and Fidelity's FBTC, was absorbing roughly 2 to 3 times more Bitcoin per day than miners were creating. That imbalance was one of the key reasons Bitcoin exploded upward in the first half of the year. But since then, ETF flows have cooled down, and for the first time in months, we saw meaningful outflows. That doesn't mean ETFs are dying. It just means that inflows are no longer offsetting the reduced supply as aggressively as before. Combine that with leveraged longs getting wiped out and price falling back into a previous support area, and you create one of the classic conditions for the start of a liquidity squeeze. Now, liquidity crises in Bitcoin don't happen when the price is stable. They happen in the extremes. They happen when miners are stressed, when ETF inflows spike suddenly, or when long-term holders refuse to sell into weakness. And believe it or not, all three of those ingredients are starting to show up. Bitcoin miners, for the first time in months, have begun selling slightly more BTC than usual, but not because they're panicking, because they're stressed on margins after the halving. Their selling actually removes supply from future circulation, because it tends to be absorbed by OTC desks or ETF creation units. Meanwhile, ETF issuers, especially BlackRock, have continued adding small but consistent inflows even on red days. It's not the roaring inflow tsunami we had earlier this year, but it is still net positive demand during a dip, and that's rarely bearish. And then we have long-term holders, who, as we said, are not selling. In fact, the percentage of circulating supply that has not moved in over a year is almost at a new record. This is the kind of behavior that preceded the 2020 rally, the 2017 rally, and the mid-cycle run in 2021. When long-term holders refuse to sell and new buyers begin to re-enter, the available supply becomes thinner and thinner until the market hits what analysts call the elastic zone, where a small inflow can produce an outsized move. But let's not get ahead of ourselves. There's another side to this story, and it's the macro side. Analysts from Morgan Stanley, Deutsche Bank, and several macro desks this week are warning that the broader risk environment is shaky. Rate cuts look uncertain. Global manufacturing numbers are weakening. China is slowing again. And when macro traders get nervous, they reduce exposure to everything: equities, risk assets, crypto. That's why this liquidity conversation matters so much. If macro pressure stays negative but Bitcoin's available supply continues shrinking, you get this weird tug-of-war where the price wants to fall because of sentiment, but wants to rise because of structural supply. And that tug-of-war is exactly why analysts are split. Let's go deeper into that divide. On one side, you've got bearish analysts arguing this isn't a liquidity crunch at all. It's simply a correction. They think Bitcoin needs one more deeper flush into the lower 90s or high 80s before it can stabilize. Some macro commentators believe the recent ETF outflows will continue unless rate cuts actually happen. They argue that institutional buyers are cautious and that this pullback could drag further. That's the cautious side. But on the bullish side, you've got on-chain analysts, ETF researchers, and several high-profile voices making a very different case. Ki Young-ju from CryptoQuant said this morning that Bitcoin's current supply structure is almost identical to the pre-bull phases of 2020 and 2017. Willy Woo pointed out that coins held in what he calls strong hands are at the highest levels in a decade. And ARK Invest analysts published a report last week saying that Bitcoin's liquidity conditions are tightening on every time frame that matters, their words, and that once buyers return, even modest demand can move the market disproportionately. Which brings us to the heart of today's question. Are we actually watching the early stages of another Bitcoin liquidity crisis forming? The honest answer is that the early signs are there, not guaranteed, not certain, but undeniably present. Forced liquidations clearing out leverage, long-term holders accumulating, ETFs absorbing supply even on red days, miners sitting on reduced output post-halving, exchange balances falling. These are the ingredients. They're not the finished product, but they're the ingredients. Now we're approaching the halfway mark, so this is a good moment to take a quick break. When we come back, we'll look at what typically happens after these liquidity squeezes begin, how long they last, what the last 3 example cycles tell us, and what analysts expect for the next 6 to 12 months, based on the underlying supply trends. Stick with us. We'll be back in just a moment.
Avoiding your unfinished home projects because you're not sure where to start? Thumbtack knows homes, so you don't have to. Don't know the difference between matte paint finish and satin? Or what that clunking sound from your dryer is? With Thumbtack, you don't have to be a home pro. You just have to hire one. You can hire top-rated pros, see price estimates, and read reviews all on the app. Download Thumbtack today.
All right, let's jump back in, because the second half of this story is where things get fascinating. Whenever Bitcoin enters one of these supply tightening phases, something interesting happens. The price action becomes completely disconnected from retail sentiment. Retail traders look at the red candles and panic. They think the bull run is done, but the people paying attention to the deeper metrics are seeing the opposite. They're seeing setups. This happened in 2020, when Bitcoin dropped under 9,000, and everyone thought the halving failed. Meanwhile, long-term holders were accumulating at one of the fastest rates ever recorded. Then the market squeezed, and Bitcoin went from 9,000 to 40,000 in a matter of months. The same thing happened in 2017. In mid-2017, Bitcoin dipped from 3,000 back to 1,800, and analysts at the time thought the run was over. What they missed was the supply data. Coins leaving exchanges, wallets showing accumulation, and OTC desks reporting increased institutional interest. Looking back, it was textbook. And that's why these liquidity conversations matter. Not because they predict price direction perfectly, but because they reveal when the supply structure is tilted heavily in one direction. Now, I want to highlight something ARK Invest said in their latest note because it ties everything together. They said that Bitcoin's ETF-driven liquidity funnel will likely intensify with each correction, not weaken. What they meant is this. Every time the price dips, ETFs, especially the ones managed by long-term institutional allocators, quietly reduce supply further by buying from weak hands. It's not dramatic. It's not emotional. It's not a huge spike in a single day. But it adds up. And at some point, when the buyers do return in size, the supply won't be there to meet them. That's when liquidity crises turn into explosive moves. Another fascinating detail is what's happening with the Bitcoin issued per day. After the halving, miners now only produce around 450 BTC per day. At peak ETF inflows earlier this year, the demand was closer to 1,400 BTC per day. Even now, even with reduced inflows, the ETFs combined are still absorbing more than miners create on most days. Not by a huge margin, but by enough to matter when sentiment flips. But again, we have to stay balanced. Not every liquidity crunch leads to an immediate rally. The 2015 and 2018 liquidity squeezes took months to resolve, and both included sharp downward moves before the eventual recovery. That's why analysts emphasize patience during these phases. Liquidity crises aren't about timing the exact bottom. They're about recognizing the environment. They're about seeing when supply is tightening, even if price isn't rising yet. To wrap this up, let's talk about what the next 3 months might look like. If macro pressure continues, Bitcoin could still see another leg down. If rate cuts get delayed again, or global markets become more risk-off, crypto will feel it. But if ETF inflows return, even modestly, and if long-term holders continue refusing to sell, and if miners continue to operate under post-halving constraints, then the supply side of Bitcoin becomes incredibly thin. And thin supply is exactly what sets the stage for the kind of rallies people remember for years. So is this the beginning of the next Bitcoin liquidity crisis? The signs are there. They're not confirmed, but they're forming. Forced liquidations, long-term accumulation, thin exchange balances, ETF hunger, miner stress, it's all lining up. And the truth is, these moments don't look bullish when they're happening. They look confusing, frustrating, and even bearish. But in hindsight, they're the foundations of the next chapter. Thanks for listening to this deep dive. Make sure you follow the show, leave a 5-star rating, and let me know what you think. Are we in the early days of a liquidity squeeze, or is this just another correction? Either way, stay focused, stay calm, and as always, we will see you at the top.